Here we have Accounting 202, Chapter 13, Problem PA13-2. And This chapter is on financial statement analysis. And so let's take a look at this data. It says the comparative financial statements prepared at December 31, 2013 for Pinnacle Plus showed the following summarized data. And so we have actually 2 years of data reflected here. We have income statement data at the top, sales revenue, cost of goods sold, gross profit, operating expenses, interest expense, and income tax expense, and net income at the bottom. And we also have balance sheet information reflected. We have assets at the top and liabilities and equity at the bottom. And as you can see, our balance sheet for both years are in balance. Now, a couple of things to note about this information presented. At the bottom here, it says 1/2 of all sales are on credit. So if we go back up to sales revenue, notice that's the reference for the asterisks shown up here for sales revenue. In 2013, there was $110,000 of sales. Half of those sales were credit sales, so that would mean the other half of those sales were cash sales. So keep in mind that it is credit sales that generates accounts receivable. And so we'll have to use that information when we get into those related ratio calculations. And of course, the same applies for the year 2012. The other note here, and this is something that relates to retained earnings with that cross. The referencing is the cross. It says during 2013, cash dividends amounting to $6,600 were declared and paid. And that is reference to retained earnings because there are basically two types of transactions that go into retained earnings. And those types of transactions that affect retained earnings would be the net income or net loss of the business for the period under review. Net income would be added to retained earnings. Net loss would be subtracted from retained earnings. And the other type of transaction that affects retained earnings for the period under review would be dividends. Any dividends declared for the period would be deduction from retained earnings. So again, what it's giving us here for the year 2013 are the cash dividends that were declared and paid. And that amount again was $6,600. So let's take a look now at what we need to calculate. And so under required, we have a number of different items that we're going to have to work on. Item 1, 1A and 1B. Item 2A, 2B, 3A, 3B, 4A, 4B, 5A and B, 6A and B, 7A and B, and finally 8A and B. Now the way that we should probably proceed here is to calculate each ratio as it's being asked for from number 1 through number 8. And what I've done is I've made an Excel spreadsheet available here on the right side of the screen. so that we can show any calculations that need to be made. So the first calculation here, the first requirement is in 1A is to compute the gross profit percentage for 2013 and 2012. Now for gross profit percentage, we need to look at the information in the income statement. And so let's see if we can show this up here. 2013 and 2012. We will show let's see, we'll show sales revenue for 2013 is 110,000, and for 2012 is 99,000. And then the next item on the income statement is cost of goods sold. And cost of goods sold is deducted from sales revenue to arrive at gross profit. So we'll show cost of goods sold as negative amounts. And then to get gross profit, we can use a quick formula to simply subtract cost of goods sold from sales. Copy that formula over. And so our gross profit for 2013 is 58,000, and for 2012 is 51,000. Now what I should have here is an extra column because if we want to show our percentages in the column next to the dollar amounts, that would probably be the best way to show that information. And now when we apply percentages, when we calculate percentages to the income statement, we need to remember that on the income statement, sales, actually net sales, but in this example, we don't have net sales, we just have sales. Sales is always 100%. And so to calculate sales as a percentage of sales, that's a division calculation, and so we would take that amount and divide it by the same amount, and that would give us, it shows as 1 there, and we would need to actually reformat that cell as a percentage, and then we can copy that formula down. Of course, for the percentage of cost of goods sold to sales, we would take cost of goods sold and divide it not by cost of goods sold but by sales. And likewise, to calculate the gross profit percentage, we would take the gross profit and divide it by not by the gross profit but also by sales. And so we can see that, and we can copy this over, by the way, to the next column. So that will provide us with the information asked for in 1A, and that would be the gross profit percentage for 2013 and the gross profit percentage for 2012. Now let's see if that information is going to work for us when we enter that information into the Connect worksheet. For 2012, it's 51.52%. And by the way, Connect asks us to round your answers to one decimal place. So 51.52 becomes 51.5. And for 2013, 52.73 will become 52.7. And we can do a quick check. If we go to the bottom of our Connect worksheet, we can do a quick check to see whether those calculations are correct, and they in fact are correct. Okay, in 1B, the question relative to the calculations just completed, is the trend in the right direction? And the answer is, the question is basically, is gross profit going up from 2012 to 2013? And gross profit, based on the gross profit percentage that we just calculated, appears to be going up. The gross profit percentage in 2012 was 51.5%, and it has increased slightly in 2013 to 52.7%. So we would probably want to answer this question yes. All right, moving on to the next item, item 2A. 2A asks us to compute the net profit margin for 2013 and 2012. Keep in mind, item 1A asked us to compute the gross profit percentage. And so, although the terminology is a little different, in 1A it's asking for gross profit percentage. In 2A, it's asking for net profit margin. Notice the answer for both 1 and 2, the answers are expressed as percentages, so the calculations are basically done the same way. So if we go back up to our income statement information, we can actually add on that information to the information that we already have on our Excel spreadsheet. And so we would put in operating expenses for both years. That would be, let's see, 36,000 for 13 and 33,000 for 12. And then of course we have interest expense, $4,000 for 13 and $4,000 for 12. Now we have a subtotal, income before income taxes, and the acronym that we usually use for that is net income before income taxes, or NIBIT, N-I-B-I-T. And so that's going to be we can use a formula there to basically, you know, since we put in cost of goods sold as a minus amount, we should also put in operating expenses and interest expense as negative amounts as well. And so let me put in those negative signs so that when we use the formula, it's going to work for us. So I've got a minus on both of those amounts for operating expenses, and also both of the amounts for interest expense. And so again, going back to net income before income taxes, we can use a formula, and that calculation, net income before income taxes, would be basically starting with gross profit and then subtracting operating expenses and subtracting interest expense. So our formula then would be to add these three numbers, one of which is a positive and the other two of which are negatives. And as we can see, these two amounts agree to the income statement data shown here. And then the last item we want to show is uh, income tax expense. And again, we would probably be wise to enter this in as negative amounts, minus 5,400 and minus 4,200. And so that would give us a bottom line that we call net income. And again, we can use another quick formula, and basically starting with NIBIT, net income before income taxes, minus income tax expense to give us net income. And we can copy that over to 2012, and so there's our net income. And so what we need to do here is copy our formula, and to copy our formula, we want to make sure that our denominator for all of these calculations from sales to net income, we want to make sure that the denominator is the same number, that number being sales revenue. And so as you can see, that's what I've done here. I've made the denominator a constant by adding the dollar sign before the column designator, which is C, and also a dollar sign before the row designator, which is 3. So our denominator is in cell C3, and so in our calculation, our denominator reference is to that number, which is at C3, and it's held constant with the dollar sign before each of the column and row designators. And so what that basically, notice as we move down from row to row, the numerator amount for each successive row changes. And then by keeping the denominator amount constant, that simply allows us to copy that formula down. And notice for net income, which is 12.6, the calculation here, which yields a percentage of 11.45%, the calculation is basically taking net income, C10, and dividing by sales revenue, which is C3. So that's really not that important, not really a part of this course per se. It's just to illustrate how Excel works, just using simple formulas. So we need to do the same thing for the 2012 calculations. And as you can see, I've already made the denominator a constant, and so I will simply copy that formula down, and I probably want to turn off the highlighting for those in between calculations. So we can see here that our net income or net profit margin for 2013 based on a net income of $12,600. Our net profit margin is 11.45%, and for 2012, based on net income of $9,800 and again sales of $99,000, our net profit margin or the percentage of net profit is 9.9%. So let's see if we can input those two amounts here. For 2013, it's 11.45%. And again, it's asking for rounding to one decimal place. And for 2012, it's 9.9%. And the question here is the trend going in the right direction? And the question again really is net income going up as a percentage of sales? And we can see from our calculations that net income went from 9.9% in 2012 to 11.45% in 2013. And so I think it would be safe to answer that question yes. We can do a quick check. We're using check my work at the bottom. And let's see if we're okay. We're okay on both questions for both number one as well as number two. Okay, moving on to number three. Now, number three is a little bit different. It's asking us to compute earnings per share for 2013 and for 2012. And that's in 3A, and again in 3B, as you've probably figured out by now. The question for the B part of the question is what about the trend? Is it good or bad?